One penny, that's all it took. A single 1 cent rounding error on a tax return triggered a $50,000 federal audit, and the person it happened to had no idea they had done anything wrong. Today, I'm going to walk you through exactly how that happened, why the IRS caught it, and the specific things you need to know right now to make sure it never happens to you. Hey, I'm Paulette with PRF Tax Service. I help freelancers, gig workers, and small business owners navigate taxes without the stress, year round. If you're new here, hit subscribe because I post real tax strategies every Tuesday and Thursday that are designed to save you money and keep you out of trouble with the IRS. Now, let's talk about this audit. The person in this story was a small business owner, a consultant. She had been in business for several years, filing her own taxes every year using tax software. She was organized, she kept receipts. She thought she was doing everything right. And for the most part, she was. But there was one small problem hiding in her numbers that the IRS system caught immediately. Here's what happened. When you file a tax return, the IRS doesn't just accept your numbers at face value. Their automated system, the one I talked about in my last video, cross references everything. Every number on your return gets checked against third party data, your 109s, your bank records if they've been reported, your prior year returns. And the system is looking for inconsistencies, places where your numbers don't quite line up. In this case, the consultant had received a 1099 from one of her clients for $47,832.17. 17 cents. That's what the client reported paying her. But when she entered her income into her tax software, she typed $47,832. She rounded down, just 17 cents, less than a quarter. The IRS system flagged it immediately, not because 17 cents is a lot of money, but because the discrepancy, even a tiny one, between what was reported on her 1099 and what she reported on her return triggered an automatic review. And once that review started, everything else on her return got scrutinized too. And that's where the real problem began. Because once an auditor started looking at her full return, they found other issues: deductions that weren't properly documented, a home office that she had been claiming but couldn't fully substantiate, business meals that she had no receipts for, vehicle expenses that were estimated rather than tracked. None of these were intentional. She wasn't trying to cheat anyone, but she couldn't prove them. And in an audit, the burden of proof is on you, not the IRS. If you can't prove a deduction, the IRS disallows it. And when deductions get disallowed, your taxable income goes up. And when your taxable income goes up, so does your tax bill. And then they add penalties and interest on top of what you owe. By the time the audit was resolved, she owed over $50,000 in back taxes, penalties, and interest, all starting from a 17-cent rounding error that opened the door. Now, let me be very clear about something. The $50,000 she owed was not because of the 17 cents. It was because once the door was opened, the auditor found legitimate issues with her documentation. The 17 cents was the trigger. The lack of documentation was the problem. And this is the most important lesson from this entire story. It is not enough to have legitimate deductions. You have to be able to prove them. The IRS does not take your word for it. They want receipts. They want mileage logs. They want bank statements. They want documentation that clearly connects each expense to your business. If you can't produce that documentation, the deduction goes away. Simple as that. So let's talk about what you need to do right now to protect yourself. Step one, never round your income numbers, ever. Enter every dollar and every cent exactly as it appears on your 1099 or your bank statement. The IRS has the exact number from whoever paid you. If your number doesn't match theirs down to the penny, and that's a flag. Step two, keep every receipt, every single one. I don't care if it's $4.50 for parking or $12 for a business lunch. If you're deducting it, you need to be able to prove it. Use an app like Expensify, or even just take a photo of every receipt and store it in a dedicated folder on your phone. The IRS can audit you for up to 3 years after you file, and in cases of fraud, up to 6 years. Your documentation needs to last that long. Step three, keep a mileage log. If you're deducting vehicle expenses, you need a written record of every business trip, the date, the destination, the business purpose, the number of miles. This does not have to be complicated. There are apps that track it automatically. But you need something. A rough estimate is not going to hold up in an audit. Step 4. Document your home office properly. If you claim a home office deduction, measure the space, take photos of it, and keep records showing it's used exclusively and regularly for business. If an auditor shows up, and yes, sometimes they do show up, you need to be able to show them the space. Step 5. Make sure your income matches your 1099s exactly. Before you file, gather every 1099 you received. Add them up. Make sure the total on your return matches or exceeds that number. If you earned income that wasn't reported on a 1099, include it anyway. Underreporting income, even accidentally, is one of the fastest ways to end up in an audit. Step 6. Reconcile your books regularly. Don't wait until tax time to figure out what you earned and spent. If you're reviewing your numbers monthly, you'll catch discrepancies before they become problems. A simple spreadsheet works, a bookkeeping tool works better, but whatever you use it consistently. Step 7. Work with a tax professional. I know I'm biased here, but this story is exactly why it matters. A professional doesn't just enter your numbers. They ask the right questions. They flag issues before they become problems. They make sure your documentation is solid before your return ever gets filed. And if you do get audited, they represent you. You don't have to face the IRS alone. Here's the bottom line: the IRS system is sophisticated, automated, and remarkably good at catching inconsistencies, even tiny ones. A 17-cent rounding error is all it took to open a door that cost one person $50,000. You don't have to be doing anything wrong to get audited, but you do have to be prepared. Keep your records, document everything, report your income exactly. And if you're not sure whether your return is audit proof, let's talk. I have free 15-minute consultations available, and the link is in the description. Let me take a look at your situation and tell you honestly where you stand. And grab the free tax savings checklist in the description too. It's a great starting point for making sure you're capturing all your legitimate deductions the right way. Drop a comment below. Did this story surprise you? Have you ever been audited or know someone who has? I read every single comment and I want to hear from you. Subscribe if you haven't already. New videos every Tuesday and Thursday. I'll see you in the next one.